As expected, the Fed added another 25 basis points to the federal fund rate and maintained a hawkish tone, acknowledging sticky inflation. Notably, few months ago, inflation was driven by stubborn energy prices. Then it was food. Then it's houses. Now it seems that the biggest inflation force is becoming wages. So the cycle is becoming more obvious here, especially with the unemployment rate maintaining pre-pandemic level of about 3.4%. So back to the wages thing. In short, the demand for workers continues to be strong, forcing businesses to offer higher compensation, which increases the overall cost of production, which again decreases the operational margin, unless price tags are adjusted to reflect the higher cost, particularly for hospitality workers who saw almost 6.5 wage growth year over year in December 2022. Money market and capital market yield pushed up beyond January's level, going as high as 5.13 for the 6-month Treasury and 5% for the 1-year Treasury. In addition, the 3, 5, 7, and 20-year Treasuries again pushed beyond the 4% yield, getting closer to the October level, some of them even exceeding that. And they are expected to go even higher with the current market trend. That said, it is intuitive to wonder how much more corporate bonds are paying for the same duration. Surprisingly, almost nothing. It seems that in 2021, many high credit rated businesses issued cheap debt in anticipation of the rate hike cycle and not issuing any more debt in form of bonds for the time being because they already issued that debt at a cheaper rate, as we said. As a result, AAA and AA corporate bonds with comparatively good coupons are priced with high premiums, in turn driving their yield down, making the overall investment not worth it compared to the treasuries. In February, investors were able to lock in a 5% return by buying a US Treasury and wait for its maturity in February next year. Therefore, it is natural to expect equity market to retreat or stay flat at least, and that it did. For example, the S&P for the month was negative 2.61, while the Dow was negative 4.19 and the Nasdaq was negative 111, followed by the Russell, which was negative 1.81. Overall, when you look at all the sectors, you notice that there was a retreat across all of them, especially in energy. The only sector that kind of survived this was tech. Another important factor is that in January and February, the earning reports started coming out, and we saw companies reporting their earnings for the quarter, some of them for the year, and that's interesting to look into because there's a lot of trends and there's a lot of revenue growth, or at least decrease, happening. We will be issuing another video with detailed look into that, so stay tuned.